Investing in US real estate can be an exciting opportunity for Canadians, but navigating the tax rules and structuring your investments properly is crucial. Today, we'll break down the key investment strategies, tax considerations, and the best business structures for Canadians investing across the border. Before getting started, let's talk about the 3 most common investment strategies in US real estate: rentals, flipping, and wholesaling. Owning rentals is the classic buy and hold strategy, owning a property and renting it out for steady, long-term income. While this approach offers passive income, it requires a large upfront investment. You can outsource property management to reduce the workload, but you still need to ensure you comply with cross-border tax regulations. Next is flipping, which involves buying properties, renovating them, and selling for a profit, usually within a short period of time. Flipping is highly capital intensive and hands-on, but it can deliver high returns if done right. One major consideration: liability. Lastly is wholesaling, which is when you don't actually buy the property, you just find deals and pass them on to buyers for a fee. This strategy requires minimal investment, making it a great entry point, but strong negotiation and networking skills are a must. Now let's talk about choosing the right business structure. This is one of the most important steps in cross-border real estate investing and will depend on what kind of real estate investing you are doing. Your structure affects your taxes, liability, and how your profits are distributed. Let's go over your options. A sole proprietorship is ideal for first-time investors or those with a single rental or wholesaling operation. You file only one personal tax return with the IRS and claim foreign tax credits to avoid double taxation and reduce your Canadian tax bill. But there's a major downside. There's no liability protection. If something happens, your personal assets could be at risk. This is why we don't recommend sole proprietorships for flipping, since it involves contracts, permits, and risks. Plus, Americans are more litigious than Canadians, so while you may think a lawsuit is unlikely, think again. The limited partnership is perfect for Canadians investing in US rental properties or pooling money with partners. LPs offer liability protection and prevent double taxation because income is passed through to investors and taxed only once. Let's use an example to see how taxation with a limited partnership works. Imagine two sisters, Wendy and Shelley, who form a limited partnership to invest in US rental properties. Wendy is in the highest tax bracket and Shelley is in a mid-range tax bracket. If they each make $50,000 in profit, they pay US taxes first, but get credit in Canada to offset double taxation. Their total tax liability depends on their personal Canadian tax rate. Wendy's US tax payable is $7,500 and her Canadian tax payable is $19,000 after deducting a foreign tax credit. Shelley's US tax payable is also $7,500 and her Canadian tax payable is $10,000 after deducting a foreign tax credit. Shelley's Canadian taxes are lower than Wendy's because Shelley is in a lower tax bracket compared to her sister. One nuance of the limited partnership is that by law, this arrangement requires a general partner. This person is responsible for decision-making on behalf of the partnership and is the person or entity that assumes all liability over and above the limited partner's investment. Because of this, essentially unlimited liability, we recommend forming a US LLC, limited liability company, that owns 1% of the partnership. You can see what this looks like in this diagram. In this situation, the LLC is technically double taxed, but only on 1% of the profits. Lastly is the US C Corporation, or C Corp for short. We usually recommend this for flippers and wholesalers, not rental investors. The biggest benefit: you can invest profits without personal tax liability, keeping more capital for future deals. Just note, if you want to bring money back to Canada, you need a smart strategy to minimize taxes on the transfer. Many Canadian investors run into the same tax mistakes. Here are a few things to watch out for. Don't use a US LLC for real estate. The Canada Revenue Agency does not recognize LLCs as flow-through entities, which can lead to double taxation. Be aware of tax on split income, TOSI, if you plan on income splitting with family members. Canadian investors can't use the US 1031 exchange tax deferral strategy, so you need a solid exit plan. Remember, US lawsuits happen more often than in Canada. Liability protection is essential. Now that you understand your investment options and tax strategies, it's time to take the next step if you're serious about investing in US real estate as a Canadian. Book a consultation with a cross-border accountant to make sure you're setting up your investments the right way from the start. If you found this video helpful, hit the like button, subscribe for more tax and business advice, and drop any questions into the comments below. We'll see you in the next video. Thanks for watching and happy investing.